Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, I'll make a start. Ooh, it works for once. Okay, when you're ready. Excellent. So a few things before I get going with the lecture. First of all, the online test. I think all of you did it, or almost all of you. Very, very high percentage, 90 plus. You have your mark, right? It was given to you once the mid-semester closed. Oh, the mid-semester, it's not a mid-semester, online test closed. From what I saw, the marks, most of you did very well. So good work. I'm glad that you took it seriously. You studied. There was a lot of 20s, a lot of, sorry, it was 16 questions, right, or whatever it was. A lot of you got 100%, quite a few in the 90% range, and then a few who just just took it for fun, I guess. They had 2 questions correct or something like that, or 3 questions correct. And that's fine. You can, it's redeemable, I understand, and optional, but for those that took it seriously, well done. In terms of if you made a mistake with something, I already had a few emails and I answered some questions in the consultation today as well about some errors. And that's great. That's what I want to see. If you made an error, don't get frustrated and angry at me or at yourself. It's self-defeating, doesn't do anything, doesn't help anybody. Take it as an opportunity to learn because of your mistake, so that you don't make the mistake again in the final, right? Because the first part of the final, you're going to see very similar questions. Calculate NOPLAT, calculate free cash flows, calculate value per share, calculate the WACC, calculate invested capital, calculate ROIC. I'm going to ask you the same questions again in the beginning of the final. There's a multiple choice section. And in the multiple choice section, about half the questions, maybe a third of the questions will be exactly the same as what you saw here in this test. Well, different scenario, different numbers and everything, of course, but same questions. And then the other sections of the mid-semester will be the ratio calculation, which you haven't seen before, and theory. Theoretical questions, not calculation questions. This online test was all calculation questions. So there will be some theoretical questions in the final as well. And if you want to see the structure, go to the past exam. It's going to be exactly the same. There's going to be a multiple choice section for quite a few pages, and then a short answer for the rest. The difficulty is subjective. So it's, if your question is it going to be the same difficulty? That's impossible to answer. My opinion is yes. Your opinion may be different. So I think it is, but if you disagree, then I guess we have to disagree. But the difficulty from my perspective will be the same in the final as it was for the online test. So if you got 100%, keep doing what you're doing, keep taking the course seriously. Thank you. In terms of the assignment number 1, I'll email you. Waddle is horrible. All right. Let's be honest, it is pretty crap. So it's kind of annoying for me to give you feedback. It's very annoying. It's actually very difficult for me to give you feedback, not even annoying. If it was annoying, I would still do it. But it's difficult to give you feedback, written feedback. It's easy to give you just a mark, a number. But no feedback means that you cannot correct your errors in the first assignment. Remember, one part of your mark for the second assignment is correcting any mistakes you made in the first assignment. So I need to tell you where I deducted marks and what you need to fix. And Waddle is not good with that. It's good for giving you a number and that's it. So what I'll do is each team I'll email an answer sheet that's available to you that I used and Heather used when we marked the assignment. That's in the blah, 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 blah. Where is it? I've got a lot of stuff on here. There it is. It's in this folder. It's here. So you're going to get an email as a team. You're going to get an email with a mark. So it's the answer sheet. The marking sheet looks like this. You'll have a mark here out of 25 and some comments here. Right? So out of 25, the average was like 18, something like that, 17, 18, something like that, something in that range. There was a few 22s. That was the highest. The lowest was, I don't know what, 13, 12, something like that. So here, before you get your individual comments, I want to talk about some general comments, because the comments that you'll get will not be extensive. There will be quite a few, but it won't be like 3 pages, because it's just me and header marking. We don't have 20 days to mark the assignment, so I cannot give you an essay. So some things, there's some things that I deducted marks for, or header deducted marks for, that you won't get a comment on. But they don't need fixing for the second assignment. So the things that are comments here are just things you need to fix for the second assignment. Okay, so, but before that, I want to give you the general feedback on common mistakes. Let's talk about statement of changes in equity. So that was done, so let's go to KGW here. You guys did the income statement very well. I have to say I saw very few mistakes. But if you go from the income statement to the statement of changes in equity, things change a little bit. Whoops. So a few of you, obviously, I don't know if you were confused or you didn't know what you were doing, or if you didn't give this attention. But the statement of changes in equity is important. So if you go to the annual statement of JB Hi-Fi or any company really, what you'll find is the main balance sheet statement, the balance line item statements, they're called, the main financial statements, will include a statement of changes in equity. It looks something like this. And this information does need to be entered into KGW here. The mistake that was most common is in this row here, row 41. Quite a few of you missed the buyback. There was a huge buyback in 2011. Buyback is a negative issue, and that should be a negative number here. Surprisingly, quite a few of you missed the huge share issue for 2017 to fund the Good Guys acquisition. It was $400 million. It's black and white. It's right there. So the fact that you missed that seemed a little perplexing to me and confused, but okay. So that's huge. $400 million, not $400, $400 million. That's a number you cannot ignore. So when you start ignoring numbers here that you should enter into, these adjustments, which is just a balancing adjustment to make sure your model balances, become very large. So ideally what you want is these adjustments to be very small. They don't have to be zero, but very small. And $400 million is not small. The $200 million buyback, whatever it was, the exact number, that's not small. Right? So I took marks off for that. So please check your statement of changes in equity. Start with seeing if this balancing function is close to zero. If it's like 11 million, 20 million, I didn't care. But when it starts exploding, 150 million, 200 million, 400 million, you missed something very important. Yeah? So that was a common mistake. Additional common mistake I have here is additional analysis. You guys were pretty good in doing what I asked you to do in the workshops and hints I gave you. You guys paid overall quite good attention. But in terms of additional analysis, the things I was looking for was you could have done the bare bones model to value your company. It's a very simple model. I think I talked about it in lecture whatever 5. Yeah, there it is. So you could have used this model to value JB Hi-Fi. That I was looking for that, or some kind of an alternative discounted cash flow model to KGW. Those of you that did use this stopped here. That's not a share price. You need to deduct the debt, the capitalized leases, divide by the number of shares, and then you get a share price. So you cannot stop at enterprise value. You have to take it all the way to this price per share. Right, so if you stopped here, the equivalent would be you stopped with KGW, that you stopped here in the enterprise value. That's not good enough. You needed to subtract all that. So for JB Hi-Fi, that was a number here, 400 million, something like that. That was about 715 here, million. That was 24.5 million. Divide by the number of shares, you get a share price. So that's what I was looking for. A lot of you missed that, or if you did bare bones, you didn't calculate the share price, which was not good. Then other things I was looking for was a ROIC breakdown or a DuPont analysis. I think I talked about that in lecture 3. Looks something like this. Something like that. Some of you did the ROIC decomposition like this. You didn't do ROA or ROTA or ROE. For additional marks, that's what I wanted to see as well. Even though it's an accounting point of view, it's also important just to see what the ROA and ROE are. For 2 years historical and 2 years forecast, so 2019 and 2020. Those of you that did this also didn't comment on it. You just gave it to me. You were copying a template from a past assignment, quite a few of you, which I didn't have a problem with, but you also need to discuss it, how stable it is, why not, where is it coming from, that sort of stuff. Next, common mistake CapEx, historical data in KGW. In KGW, this is what it looks like. CapEx is down here. Quite a few of you calculated this. That was a mistake. You should not calculate that. This number is given to you in the cash flow statement and elsewhere in the report, but you'll find the exact number in the cash flow statement. There it is there, that one. For 2018, this one for 2017. Quite a few of you calculated it. I didn't understand why, but the numbers, the exact, you don't have to calculate, you look it up, the exact number. So, yep. No, it should be just that number. It should, because it's capital expenditure means spending. It's not a net figure. Like if you did that, I didn't deduct any marks, but to answer your question, the answer is no. Like if you gave 54 instead of 54.4, I gave you full marks for that, but if a lot of you gave me 50 point something because you were using a formula with net PPE to calculate, that's incorrect. Yeah. Another common mistake, market value of equity. That was a big surprise actually, this number here. You guys input the book value of equity. Clearly says market value here, and you took the book value from the balance sheet, this number, again, which I didn't understand, for 2018. Market value means market value, not book value. Yeah, that number was given to you in the file that you needed for your WACC estimation, the market values of JB Hi-Fi. What else do I have? 106. What was in 106? Oh yeah, that was also quite a few times that this was entered in incorrectly. This is the additional number of fully diluted shares. You'll find that in note 3. 1.1 million, I think it was, for 2018. And the units as well. This is in thousands. It says that clearly. And you guys either put in millions or not the correct units. Should be in thousands. Even though the model says, give me everything in millions, doesn't matter. The number of shares are independent of that, and they want it in thousands. The other few things I have here in the forecast drivers, overall quite good. I was pleasantly surprised with the revenue forecasting. A lot of you did the store rollout model. A few mistakes there was you didn't break down the stores into smaller store and the bigger store. That was a common mistake, which I took marks off. You have to at least break it down into home and regular stores, at least, at the very minimum. What else was there? Oh, you needed at least 2 methods. So if you just did the store rollout model and you did well, you got most of the marks, but if there was not an alternative, at least a second stream of forecasting for these 5 years, then I took marks off for that. I wanted at least 2 methods. 3, most of you did 3 and that was good, but if you just did 1, that was not enough to get full marks for the revenue forecasting. So I probably took 1 mark, depending what you did, probably took 1.5 marks off for that. What else do I have for you? Only a few other things. That was all done fine. Retailers had that. Everybody did average. That was fine. CapEx was pretty well done. A few of you didn't link, had a fixed number here of the 2018 number, so you had 715, and then you had 715, 715, 715. When the company grows, the amount of leases they have to write goes up, so that should be at least linked to revenue at the very minimum. What else do I have here for you? The only common mistake was this phase 2. This was way too high. Many people had 4% here, 3.5%, 4%, whatever, 3.2. That's because you just did a rolling of these 5 years. That's way too high. So that doesn't pass the smell test for one reason. If it doesn't work because you're assuming that the growth that the company's experienced of that you're predicting for the next 5 years will continue forever. Way too optimistic. Yeah. So because because we've had the last sort of, since the financial crisis, the last 10 years, we had an economic boom because interest rates are very low. And then most of you forecasted the 5 years to continue that, and that's fine, but then the next 10 years, that's unrealistic. Cycles have 10, 15 years max. That's why in my portfolio, for example, my superannuation, I'm ultra conservative, right? We're at the 10 years since the financial crisis. The next crisis is coming very soon, right? Very soon. When interest rates are so low, people misprice risk, right? That's the most common mistake as investors, because they just get comfortable and complacent. And if you did that, if you assume that for the next 5 years, I was fine with that. But you cannot assume that for the next 10 years, that you just keep this high period of growth for the company, for a mature, highly competitive, for a mature company in a highly competitive industry to stay growing at 4%. So that's why I kept going on about, especially in consultations as well, but in class as well, about linking that to just the number of household growth predictions, which you can get from the ABS. I think it was 1.6 and 1.5, those sorts of numbers. Right? If you did that, that was fine. If you had 4% here, don't be surprised that your share price was $40. Right? Your share price would have been crazy. Right? If you had 10 years of 4% continuous growth, because remember, this is growth that will include both troughs and peaks. And you're just saying it's always going to go up. Unrealistic. Yeah, unrealistic. Too high. And that was the only, everything else was fine. All of these other ones were fine. You could just roll you can just roll the last 5 years, but you couldn't do that here. WACC, the only common mistake was people completely ignored the leases, which was not good. I took quite a bit of marks off for that. When I talked about leases so much in class and in workshops, I have a headache just thinking about it. And no leases in the WACC, so that was not good. And I'm talking about just negatives. Overall, the assignments were done well. I'm just talking about the negatives. So don't get discouraged. You guys, I think, did quite well overall. And the last thing I have here in my notes is the WACC error. Yeah, that error. So not maybe 10 of you out of the 50 teams had an error here for various reasons. And when you get an error here, you need to trace it. You need to, so teams that did have an error, you'll probably have a comment. Where is it? You'll have a comment here why that error occurred. And it's a combination of playing games with the formula. Some of you play games with the formulas in your forecast driver sheet. For whatever reason, I don't know why. You change these formulas somehow. Again, I have no clue why you did that. I cannot help you when you start playing games with the formula. It's really up to you. So some of these formulas got changed in the historical data. So some of you played games with these formulas. Again, I don't understand. And when you did that, you'll get errors. And a lot of these were then obvious when there was an error here in the results sheet. And because most of the errors, I think all the errors here were as a result of historical data. Right? So please don't do that. So trace the error, see where it's coming from. This is the overall error check, and throughout the result sheet you'll have these error checks, and that will tell you where the error is coming from. You should get an OK there. And some of you did not have that. I think that's it. And again, it's just the negatives because we are limited on time. I just wasted 30 minutes. I don't have another 30 minutes to talk about all the positives, but you guys did quite well. And those were just the common negatives that I saw. So I'll email you later today if I have time. I should be able to, all 50 to 49 teams. I'll email you a group email for your individual group with that, with a scan of the marking sheet and your mark. And I'll post the marks on Waddle. I don't know, maybe tomorrow, when I have time. Any questions? Okay, if you have individualized questions, please come to the consultation. If you cannot read my handwriting, I tried my best. You can, of course, come and see me and try to correct any errors. I will be looking for corrections of assignment number 1 errors in assignment number 2. Yeah, so if you go to the marking sheet for assignment number 2, I will be looking for corrections made to assignment number 1. Yeah. As you can see in the marking sheet. Okay, so no questions, really? Be brave. Okay. So let's talk about this lecture. So today's focus is about growth potential. So it's not really a lecture on assignment number 2 or anything like that. In assignment number 2, please come to the workshop this week. I'll talk a lot about assignment number 2 and ratios and what I expect and what you need to use and do to supplement what I told you in the lectures. So this week's workshop is very important, and I think that's the last workshop we have for the whole semester. So it's the last piece of pain, right? And then you'll be fine. And then I'll leave you with just the lecture pain. No more workshop pain, right? So let's talk about this growth business. So growth gets a lot of attention. I think you would agree. Growth gets a lot of attention. In my opinion, too much attention. But everybody talks about growth, this, growth, that. I like to talk about risk. Nobody wants to talk about risk, especially when interest rates are 3%. I understand people ignore risk when interest rates are 3%, but it's wrong to do that. But growth gets a lot of attention. By far the most focused on forecast for analysts and also on TV, CNBC, Bloomberg, newsreaders, all they want to talk about is growth. Okay, so this lecture is sort of dedicated to how companies can grow, how to see good growth, try to differentiate between good growth and bad growth, and there's a lot of bad growth. Growth is not the holy grail. It is not the solution to all your problems. Grow a bad business, you just increase the time until your bankruptcy, right? So a lot of examples, not just in Australia, but around the world. Tyco, Global Crossings, Enron, HIH, OneTel, plenty of companies, huge companies, billions and billion-dollar companies. They all failed because they grew. They engaged in bad growth. Woolworths, right? Look at Masters. That was a huge mistake, growth-wise. They wanted to compete with Bunnings, and they didn't do the right product mix, right? They created all these stores for hardware, and the products they had on the shelves were garbage. They were horrible and higher priced than Bunnings. So you can grow. Growth does not guarantee success. And we live in a world, unfortunately, where growth is equal to success. It's not. Nowhere close. I would rather grow as a company, as a CEO. I'm not a CEO, but if I was, I would much rather grow my business at inflation than engage in some stupid acquisition. It's not good growing at 2%. It's not impressive. It's not good. You're just growing at population growth. and a lot of mature businesses do. JB Hi-Fi is one example where the company sort of reached its peak in terms of organic growth. So that's why they did an acquisition to do artificial growth. But it's much better than failing, engaging in bad growth, and there's plenty of it. Okay, so it's more of a qualitative lecture, not some numbers, but not as many as in the past. We're going to talk about growth potential, and I'll talk about my overview. The two types of growth we have organic growth, and we have artificial growth, or inorganic growth. It means the same thing. JB Hi-Fi is a good example because they've done both recently. They keep, as many of you have outlined in your store rollout model, grow at about 5, 6, 7 stores each year. That's organic growth. Buying Good Guys, 100 plus stores, is an example of inorganic or artificial growth. Organic is the safer option, but slower. And inorganic is the more aggressive option, but faster. And inorganic doesn't just have to be new investment, just acquisitions, like in the case of Good Guys and JB Hi-Fi, also new investments. An existing company starting up a business on their own. It tends to happen, not as much as in the past, but still, yeah, start something from scratch. Tesla is a great example of originally being a car company, then becoming a solar company, then becoming a space exploration company, right? And now they want to colonize Mars, right? Elon, crazy guy, fascinating guy, crazy, but in a good way, good crazy, right? There's good crazy and bad crazy. He's good crazy. And then we're going to talk about these market implications and give a few examples. So let's talk about this growth. So the definition of growth is, as I said, there is business growth or organic growth, natural growth. It has many names. The ability, and that is just, if you want a definition, the ability of a company to grow its core business. It has a business model. It has some kind of a business, whether it provides a product or a service or whatever it is. It has that and wants to grow and usually increase market share or give you don't have to increase market share. You can also give your customers different products, right? So Apple, for example, it pains me to use that as an example, but Apple was a computer company, if you want to call it that. Then they had a revolutionary product called the iPod. That morphed into the iPhone, and now they're more of that's their main product now, right? So they had a core business of expensive electronics. No, that's not true. Core business of computers that sort of evolved over time, and it grew really naturally. It didn't really. There was no some crazy acquisition or anything like that. The other type, of course, is artificial growth. Generally through an investment, which can be small or large, and that may involve either through new projects, you actually starting up a project from scratch from the very beginning, like Apple. iPod was, they saw, before iPod, you guys are probably too young to remember this, but I'm not, unfortunately. But before the iPod was the Discman. Yeah, that was horrible, right? So you had a little CD, you put that into that, you've got 22 songs, 22, not 22,000 or 22 million now probably, right? 22 songs, that's all you can fit on a disc. You put that in a disc, the disc would spin, right? And you cannot jog with it because the CD would move and the laser wouldn't read the DVD, right? So there's a lot of problems, and it was a horrible technology. That when I was growing up, that's what people had. I had a Discman. Well, that was rough, right? That was not good. And then Apple comes along with a new project built around essentially building an interface around a hard drive to hold 20,000 songs. And the iPod was a revolutionary product. And then that morphed into the iPhone and iTouch and all these different products, and iPad eventually. But that was a new project. They didn't acquire another business. They built it from scratch. And that's a new product. You could also have geographical expansion. That's sort of what Amazon is trying to do around the world. Jeff Bezos built a company where people have an online marketplace, to sort of different from eBay. eBay is bidding, but Amazon is not bidding. It's just bringing retailers that cannot build websites themselves because it's too expensive on Amazon, using Amazon platform for a small fee. And now that's revolutionary idea. On top of having warehouses with that can ship quickly any products that somebody orders within a day instead of a week or a month. And that's a great idea. And now Amazon is expanding geographically around the world. And new projects in Australia, mining is the #1 industry in Australia. An example of a new project would be a new mine, for example. BHP, Rio Tinto, Fortescue Metals, Santos, all these companies, giants, Woodside Petroleum, giants of Australian mining, they are prospecting all the time for new mines and new wells to dig resources, hydrocarbons. That's more of an organic product. The exploration, it should really be up there. I'll change that. But again, it's a new project. And if it was, let's say you had a coal company starting to mine zinc or something, that would be a new project. So it fits there as well. But when I think of BHP Billiton, such a large company, they have everything. Copper, zinc, tin, iron ore, coal, rare earths, everything. So, but for smaller companies, you have 1 or 2 projects, and then they are success, and then you create new mines. Yeah. So that sort of growth through new projects from scratch. The quicker way, but more aggressive and more risky generally, is through a merger or an acquisition of another business. JB Hi-Fi is an example here with The Good Guys, of course. They bought stores, same sort of business model, selling electronics through bricks and mortar, actual stores, not online. But that was a large acquisition, quite an expensive acquisition, as most of you have noted in your models. Wasn't cheap, a lot of goodwill generated from that transaction, and it was very aggressive. But it was quick, it's just expensive. So that's another way to grow a business, artificially. The other things that are sort of relevant that we don't have time to discuss in this course, you probably do it in corporate finance, is a negative acquisition. A negative acquisition is where you sell off one of your divisions. It's called a spin. It's called it's divestiture or spin-off. You sell off a part of your business. Usually, you have a larger company has multiple businesses, and you decide you don't want this business anymore, or the price is right, so you sell it. Current example of this is Wesfarmers selling Coles. So Coles is owned by Australia's largest conglomerate called Wesfarmers, ASX code WES, amazing company. I own some shares. The dividend was huge, massive dividend, and good management, diversified business, really company that is using its size to maximize economies of scale and scope, basically. And they bought Coles at a time where Coles was struggling. That was in 2007, something like that, when I was doing, I think, this course, 2008, whatever it was, I think it was 2007. Coles was struggling. It was very close to bankruptcy, actually. They were struggling. They bought it for cheap. They turned the business around. They defeated Woolworths, and now they want to exit and cash in on their investment. And sell the company off. The company is going to be spun off as a separate company listed on the ASX. So that's like a negative acquisition or a sell-off, a spin-off, divestiture, whatever you want to call it. And the other thing we don't really have time for is real options, which is something you use. I'm not going to talk about it here, but you're trying to value the option of expanding. So just like with call and put options, call and put options have 2 forms of value, time value and intrinsic value, right? So intrinsic value is just ST minus X current. If you were to exercise it today, you would get ST minus X, the payoff. That's the intrinsic value. And time value is the optionality, because you especially with American options, you can exercise that option anytime you want until expiry. Try to think of that try to think of that sort of optionality in a company with investing in something, because a company, when it's considering an investment into a project or some mine, it is an option. It is a call option. The company has the right but not the obligation to enter into this investment or buy this company. So using Black-Scholes option pricing, the model that you're familiar with, to value projects is what real option valuation is all about. I don't know where we teach that. I think Dean might teach it in investments, advanced investments. Not covered in this course, but also an interesting area. Okay, so so that's sort of the two types of growth that we have, that companies have available to them. Now, how does that link to value? So far in our valuation of JB Hi-Fi or any company, if I was to pick a different company, we are focused on modeling, forecasting value in current operations, right? And opening 5 stores a year, something like that. And that's the reinvestment in those operations. So sort of opening 5 or 6 stores every year, closing 1. Right? Most probably your company is forecasted to generate free cash flow that is applied to financing flows. What that means is we didn't forecast any sort of artificial growth. We were focusing in the future on basically business growth. But we know companies have this other option. The problem with that is this is impossible to forecast, which is why we don't do it. Companies do not announce their expansion or acquisition announcements ahead of time. They would be stupid if they did, because it would increase the price. JB Hi-Fi would never say, we plan to acquire Harvey Norman next year. No company in the world has ever done that. And they never will, because first of all, all the CEO would be fired, the board would be fired, and even if you did do that for whatever reason, you would increase the price for which you have to buy the business, right? Because you announce your intentions ahead of time. Companies don't do that. Nobody does that. Right? So that's why we value the business as is. We only, in our forecasting as analysts, we have no choice, but only to focus on business growth. And is that correct? No. But again, we just have no clue what that is. Once a company announces that they plan to do an acquisition and this is the price, then we have the information, yeah, but not ahead of time. Yeah. So this, only focusing on this growth is not how the world works. The company will spend excess cash usually. In your KGW model, what the model does, which is sort of what analysts do as well, is any excess cash that's generated here is usually assumed to pay down debt. In practice, some companies do that, that's true, but most companies will probably spend any excess cash on new investments, or new projects, either from scratch or some acquisition. But we just don't know. And it is a key value driver. Yeah, growth is a key value driver that has a direct impact on what the cash flows that we're discounting, the free cash flows, will be in the future. So in any model, the growth will be usually at the very beginning of your valuation. In the forecast drivers, it was the number one thing. It was the first thing you had to input, and it was the most important. And these are the key. And revenue growth is usually, especially with a retailer like JB Hi-Fi, that's what you focus on, because all the operating costs are just linked to revenue, because they operate on a margin. JB Hi-Fi will not sell a TV if it's not able to make its minimum margin, which is whatever, 15%. Right? They'll just not buy the TV from the supplier and put it in the store. Right? So for a retailer, everything works on a margin. And that's common to all retailers. Meijer, which has been in the news lately, if you've been reading, Meijer has looks like an acquisition target. All the retailers operate, Harvey Norman, all the retailers operate on a margin. Coles, Woolworths, they all operate on a margin business. They will not buy a product from a supplier if they're not able to make at least 5, 10, 15, 20%, whatever. So let's have a look here. So first, let's talk about this organic growth, the standard growth, if you like, the natural growth. As I said, it reflects the ability of a business to grow its existing operations. Right? Organic growth often associated with fast revenue growth. Yes, it's nice to grow a business, but it is not enough in its own right to create value. The common mistake among analysts is, and few of you did this as well, you're very optimistic about the company, and there's nothing wrong with that. Companies generally, especially ones that have been around a long time, are good businesses. If they were, they would have failed. Age is not a direct guarantee to success or good value, but it is one of the factors that contribute. If you have a management team that's been in place a long time, the company's well established, it helps. It reduces the risk of the business failing. But organic growth usually doesn't always mean just high growth in perpetuity or something like that. There also has to be assets invested to support such growth. And a few teams, when you went to the CapEx section down here, this number, most of you did this correctly, but a few teams didn't have a very high capital expenditure. And what happened is, if you have a low capital expenditure spending as the company is growing, so you have positive numbers here, and you have still positive, but not very high numbers here, what you'll find is the net PP&E starts decreasing or is very flat. That does not make any sense. When a company grows, it needs more assets, right? So a common mistake among analysts, and I saw this at Credit Suisse as well, capital expenditure is not high enough to support the growth. There's no such thing as free growth. It doesn't exist. It's a nice idea to grow a company for free. It's impossible. Every company has to spend cash to grow. Every single one. So always, you should look at how you're growing the company, how its sales is growing, how our sales are growing, and how does that relate to CapEx? Because the CapEx forecast, the way it's calculated is it takes the opening PP&E, then you spend the cash via CapEx to replace depreciation and also add additional assets. So the way PP&E works is you've got PP&E here, it goes down because of depreciation. When you're growing as a company, you as an analyst have to forecast, first of all, you have to replace all the depreciation and then spend additional assets to grow the business, right? So don't just set CapEx equal to depreciation. I think I've said that before in a lecture 5, whatever it was. You have to grow more than depreciation if the company's growing, which, especially when interest rates are 3%, they grow, right? It's very easy to grow a business when financing is so cheap. But in my mind, that's nice. The growth is interesting, but it's not enough. It's not enough in its own right to create value. What you as an analyst have to do is look at the growth, return on investment, or whatever it is, ROIC in our case in this course. I keep talking about ROIC. And how does that relate to the cost? What is the ROIC-WACC relationship? And that's the whole point of this decomposition that some of you, wherever I said in lecture 3, I showed it to you at the beginning of this lecture. That's the whole point. At the very bottom, it says the ROIC-WACC spread, and you have to make sure that's positive. If you are using the argument that, the company's growing, so the value per share should be higher where it is today. Because guess what? Well, I think I showed you this before. Let's open it up again. This is the bare bones model. What we have here is growth at 5%. Okay? We have ROIC here of around 11%. That's the return. And here we have the cost, the WACC, of 10%. ROIC is higher than WACC. This is the valuation, the enterprise value, not the equity value, the enterprise value. If I increase growth, look what happens to the enterprise value. It goes up. That's good. Sales growth is a value driver. It should go up. But if I was to increase this to 12, now ROIC is bigger than WACC. I can grow this all I want. Look at what happens to the enterprise value. It goes down. Growth by itself does not matter. It is irrelevant. If you just look at the growth number and nothing else, you're wasting your time. Always be wary of analysts or business owners who are trying to pitch you an idea, who talk about growth at 8%, 9%, 12%. 12% is the magic number. There's actually some tests done by finance people in the 80s. They talked to psychologists with the intention of trying to trick people. The idea was, what percentage do we have to tell our investors or clients in order for them to invest with us? And the psychologists did an experiment, and they came back 12%. When you as a human being see, on average, 12%, you're happy. And you don't pay attention to anything else. That's stupid. 12% may sound juicy, may sound like a good number, it's irrelevant. Raw return does not matter. Return relative to the cost or the risk, that's what matters. That's why in my class, in my introductory class, I told this to my students last week, return does not matter. Everybody got scared, like what? And I said, risk-adjusted return, guys, that's what matters. It's easy to get 12% when you take a lot of risks. And then if you fail, you don't advertise that. And if you succeed, oh, look, I generated 12% return. I'm awesome. Right? Be wary of that. That's very common in finance, and it annoys me. It's deceptive. Yeah. Growth by itself is an irrelevant number. Either look at the ROIC-WACC relationship, as I showed you, as I proved to you. It doesn't matter what this number is. If WACC, the cost, is above the return, you can grow your business all you want, and if this goes up when ROIC is less than WACC, you're actually accelerating your bankruptcy. You're speeding up your failure. That's all you're doing. So never just look at the growth. As an analyst, it is not enough. Growing revenues faster than invested capital, that's what you want. And ROIC rises at the margin as the asset base is not required to grow at the same pace. So if we go back to this DuPont analysis that I was looking for, as you can see, it breaks down ROIC into three, well, tax doesn't matter, that's fixed, into its two main drivers, operating margin and capital turnover. When you as a business are able to increase sales at a higher pace than invested capital, that means you're efficient and you're becoming more efficient. So you can think of capital turnover as an efficiency ratio. Every company needs assets to generate sales or revenue. And the less assets you need to generate the same sales as a competitor, the more efficient you are. And the higher your ROIC, the better you are as a company. So this capital turnover ratio, very important. Operating margin, obviously very important. That means profitability. The more profitable you are, good for you. But think of this as like an efficiency ratio. So when you're growing a business and you can grow this at, let's say, 5% per year, but invested capital only has to grow by 3% a year, good, well done. Yeah. So look at that. It's not just look at the growth. Again, growth you will find here, good for you. But it has to be relate to what? The growth does not come for free. This will not, if this stays static, if this stays the same, and sales go up, there's only a few companies that I can think of that can do that. eBay is one. Brilliant business. Most of online businesses are very efficient because their invested capital doesn't have to grow that much. eBay does nothing. Let's be clear. eBay provides a digital platform for buyers and sellers to come together. eBay is not a buyer. eBay is not a seller. It provides a digital platform. It has servers in California, huge servers, I agree, more than the size of this room, but they don't manufacture anything. So their invested capital is very steady. And because they're cheaper than retailing, actual traditional retailing, people use it. So the sales keep going up. They get a fee from each sale, and invested capital doesn't really have to change that much. There's not a lot of companies that can do that. 20th century companies cannot do that. I've only seen that with 21st century companies, digital companies, that the marginal cost of doing more sale is very, very small or zero. Traditional companies, oil companies, manufacturing companies, industrial companies, healthcare companies, they cannot do that. So I've only seen that in digital. But if you can do that, if you can grow revenue faster than invested capital, your ROIC is going to go up. It means you're generating more returns for your shareholders, you're more efficient, you're a better company. Good for you. Yeah. So that's what you should be looking for. When you're looking for organic growth as an analyst and you want to predict it, analyze it, look for that relationship. That's the only thing that sometimes gets ignored and really annoys me. People just look at 12% and think that's great. It's not enough. You have to look at this relationship as well. With the inorganic growth, it's just dangerous. If it works, it's great, good for you, but it is aggressive. Like it says there, investment is a double-edged sword. It's not the solution. It's not the holy grail. Just growth, growth, growth. That's what everybody wants to talk about. Congratulations. That is not the full story. All right? That is not the full story. So when you're expanding, there's quite a few risks that often get ignored. Let's talk about them. First of all, expansion of capacity may dilute returns. Yeah. So remember supply and demand? Right? Standard supply and demand. What happens to the price, the equilibrium price, when the supply curve increases? Goes down. A lot of forecasting that I've seen, they predict, sales to go up and up because the company produces more of something. Well, guess what happens when the supply curve shifts up? The equilibrium price comes down. 95% of all products are price elastic. They're not inelastic, which means if the supply curve goes up, equilibrium price goes down, company makes less money. All right, that's just economics, microeconomics 1. When the supply curve shifts, equilibrium prices drop, you cannot predict that you can stay at the same price. This is what happened in Australia in 2005, 2006, where there was a mining boom. People made a lot of money in the stock market, and the companies as well made a lot of money. So the commodity prices kept going up: iron ore, coal, zinc, tin, copper, all these minerals, and the companies reacted by just opening new mines. Right? So digging more resources out of the ground, flooding the market, increasing the supply. Guess what happened to the price of all those resources? Started going down, right? Which means the analysts predicted that the price, or conveniently ignored the fact that price goes down when you increase the supply curve. So when you are just predicting the company to do more business, that does not mean that business is done at the current price level. When you increase capacity, you will likely dilute returns. Doubling the output, doubling the amount of units you produce, doubling the number of stores JB Hi-Fi has, will not double the revenue. It won't. Right? If you're predicting as an analyst that JB Hi-Fi, for example, buys 100 more stores, it will not increase its sales by the new 100 stores at the same rate it can. First of all, Australia has 25 million people. That's not a lot. And all the locations that JB Hi-Fi, in terms of populated areas, JB Hi-Fi relies on foot traffic. It needs to be in crowded spaces. Australia, if you've probably noticed, is a country that's largely deserted outside of the major cities. Right? Outside of the capital cities, there's no point in opening up a JB Hi-Fi store in a country town with 1,000 people, right? You would have 3 customers a day. Right? You'll be closing the store next week. So if you as an analyst are predicting, they can expand 20 stores forever, you're an idiot. They can't. Australia only has a limited number of people, limited number of locations that JB Hi-Fi can grow into. And it's pretty much at full growth. I mean, I looked at the store map. I can't see growth past its current number of stores at the same rate. You as an analyst may disagree. We can disagree if you like, but it's a mature company. Right? JB Hi-Fi, I would not invest in that business. If I was an investor and I had some money and I was thinking about shares, I would not buy JB Hi-Fi shares. Yeah. So be careful of that when you're predicting the company to grow, either through acquisition or some kind of an investment. It cannot just grow, double its output to manufacture something, and you forecast that would double the revenue. That's too aggressive and largely unrealistic. It ignores supply and demand. The other thing that often happens with acquisitions, and not just acquisitions, new projects, they occur at the top of the cycle. And the reason for that is easy: financing. It's easy to get a loan, and everybody does when interest rates are at 3%. The reason why you see a lot of expansion before a crisis, a lot of acquisitions before a crisis, is because of loose credit. Right? It's easy to borrow a lot of money, and you as a company or as an individual can afford that because interest expense is very low. When interest rate doubles, you fail. Right? So that's what happened in 87. That's what happened in 2001. That's what happened in 2008. The crises that we had recently, even if you go back to 2029, the Great Depression, it's all a credit crunch. It's always the availability of credit that gets restricted after a period of loose credit standards. And in Australia, this is why I would never buy a house now. It's insane. We're at the top of the cycle. We're about to get a third of the mortgage portfolio repriced from interest only to interest and principal repayments, which means people's mortgages are going to go up 30%. That would not be an issue if there was wage growth. There is no wage growth in Australia. And plus, the household to GDP ratio in Australia is highest in the world. In the world, not higher than Japan, not higher than US, not higher than Europe. It's the highest in the world. So that's just a recipe for disaster, right, in the real estate market. Same with acquisitions. When you have a period of very low interest rates, people borrow like crazy and spend, good for the economy, but then eventually, when interest rates start going up, because the central bank is trying to fight inflation or whatever the reason is, interest rates go up, and then, ouch, a credit crunch. So always be wary of companies expanding when everybody else is expanding, and always be wary of companies expanding when money is cheap. Worst time to expand. Worst time to expand. Because you're complacent. And again, like it says here, with cheap credit, the ability to expand is higher because of funding or credit availability, but it also increases the probability of overspending. Because management isn't disciplined. They look at the interest rate just like you and me, 3-4%, they borrow and buy. Same what Australians did after the financial crisis. They saw mortgages at 4%, they bought houses. Not good. So be wary of that. Always a bad signal. And this is a horrible one that always gets ignored. Do not be wary, do not think that everything is going to be okay when the company you're valuing is expanding at the same time that its competitors are expanding. That is actually one of the biggest signals that gets ignored by analysts. Concurrent expansion by competitors. Very dangerous. And companies are like, oh my God, that competitor is expanding, we have to expand to keep up with market share, whatever it is. Bad idea, right? First of all, supply and demand, because if both of you are pushing the supply curve up, both of you are you're gonna double the drop, you're gonna increase the drop in the equilibrium price of whatever it is you're selling. And second, you're gonna cheapen your product. Bad idea. Mergers and acquisitions. So mergers, form of investment, let's be clear. The benefit of the acquisition flows to the target shareholders, not to the bidding shareholders. So if a company, JB Hi-Fi is buying Good Guys, all the benefits go to Good Guys. JB Hi-Fi gets no benefit. Ideally, they combine the company and grow it, make it more efficient, so over time they get the benefit, over the long term. But when the deal is announced, immediately after the deal, the bidder shareholders are the ones paying for it. They don't get a benefit. The target shareholders win, and they win large, historically about 30%. It's called the buyer's curse. also gets ignored often. Everybody gets excited about the acquisition. It's all going to be great. Everybody's going to make a lot of money, blah, blah, blah. Right? Happens every single time. The people who make money are the target's shareholders. They make money. Okay, good, yep. No contest. Yes, that's true. The bidders do not. Over the long term, maybe. Over the short to medium term, never. Never. Wesfarmers, they bought Coles in 2007. It's 2018 now. It took 11 years to turn the company around. 11 years. Not 2 days, not 3 weeks, not a month, 11 years. It takes a long time for the bidder shareholders to get the benefit. Merger costs are often underestimated. Merger costs, they're about 2% of the deal. So if the deal is $1 billion, it's 2% of that. So whatever the purchase price is, historically 2 to 3%. Sometimes they can be higher because of complications, but generally they can be underestimated, but it is not a massive cost. 2 or 2.5%, it's not small, but especially with like a $10 billion transaction, but it's not the end of the world. This is a big one. Post-merger difficulties. Gets ignored every single time. It's not easy to combine a business. With JB and Good Guys, it's okay because the business model is basically the same. It's not that complicated. So that's okay. But when you're doing a business that's related but not quite as similar as Good Guys and JB Hi-Fi Home, then it gets quite difficult. A good example there is Merrill Lynch, Bank of America. So in the midst of the financial crisis, Bank of America bought Merrill Lynch, 2 banks, completely different businesses. Bank of America was not an investment bank. It was a commercial bank. They did mortgages. They did stockbroking. They didn't do any investment banking. They didn't do any derivatives. They didn't do any subprime loans. It took a long time. Even now, debate is whether it was a good acquisition. I would say it was okay because it was in the midst of a financial crisis, so you got a good discount as Bank of America. But the owners of the combined business, so the previous owners of just Merrill Lynch, they got a benefit because the company didn't go bankrupt. But the bidders of, so the company that bought the Merrill Lynch, which is Bank of America, the shareholders of that company didn't really get a benefit. And still, after all this time, after 10 years. Post-merger difficulties can occur even if they are within an industry. And combining 2 businesses is often underestimated or completely ignored, like it says there. I've seen it all the time. Analysts are just, because everybody gets excited. It's an M&A deal. It's an M&A deal. All this money flying around. Billion this, billion that, 100 billion this, and everybody gets lost in the numbers. And then what happens after is just, It's like the news, right? It's like there's some crazy news. Trump goes crazy, right? The usual. He goes crazy on Twitter or whatever it is. And then and then there's some crisis in the Middle East and everybody ignores what happened before, right? It's just everybody's moved on because attention span of people is very short. When you have that approach with money and investors' money or your clients' money, bad idea. Yeah, so as an analyst, always be careful that, saying yes to an acquisition. We'll talk about, there's a whole lecture on acquisitions later in the semester, in a couple of weeks. It's hard to combine 2 companies, very hard. So what I've said here is all these risks. This is a huge one, often gets ignored. This is a huge one when companies expand together. It's the same as this one, basically. So borrow a lot when money is cheap and expand because a competitor is expanding. This one is huge as well for the bidders, not for the target. This is not that big, that's fine. This one is also quite big. So a lot of risks for growing artificially. All right. So you shouldn't, just because JB Hi-Fi bought Good Guys doesn't mean you as an analyst get excited, oh, that's a good deal. Yeah, they're good. Mm-hmm. They're going to do well, right? No. Right. So let's have an example to show how this gets ignored. So I have an example here for you for this lecture. Let's look at this project. So we have some investment. Okay, let's have a look at it. The Excel file is given to you. It looks like this. So we'll talk about it from the slides. But the calculations are all there. It's just a DCF. So we've got some company here that is currently, so let's value its existing operations. This is what we sort of did with JB Hi-Fi. This is a simple company. It has one product that it sells at $1.20, and it sells 2,000 units in perpetuity. Okay? So its sales are just price times volume, nothing complicated. It's got some variable costs, it's got some fixed costs, and it's got some depreciation. Yeah, so very standard. Revenue minus costs gives us EBIT. Interest is zero, assuming tax on EBIT at 25% will be that. So this is our NOPLAT, and our NOPLAT margin is obviously, and some of you got this wrong, you scared me. NOPLAT margin, this is the existing, that's where it is. NOPLAT margin, remember, is just NOPLAT divided by sales. That's all it is. Is 13.8, which is not too bad, quite normal, right? Invested capital of let's call it billion, 1.6 billion. So once we have the NOPLAT, once we have the invested capital, we get a ROIC. ROIC is quite healthy relative to the WACC, right? Not too bad. So to value this business is the standard approach. Go from NOPLAT, add depreciation, minus CapEx, net change in working capital to get free cash flows, discount them at 8%. Your continuing value formula for all the cash flows after year 10, discount everything to times 0, add all the present values, you get the NPV. Let's say 3.8 billion. Right? Woohoo. Okay, let's consider this new project. So in the next slide, so this existing business that is currently worth, why is that different? Did I change something? It's always possible. I must have changed something. Must have changed an input of some kind. No, don't save. Must have changed an input some kind from this slide. It's okay. The existing business is this, 3.8, 3.6, whatever. Profitable, not too bad. Now this business is considering expanding. Okay. It's considering building a new plant, a manufacturing plant, whatever, it doesn't matter. So what it can do out of this plant is all the new products, it can sell at $1.10. Okay, so that's some recognition that the price does have to go down because of supply and demand. Okay, so from $1.20 to $1.10, okay. Next, the new plant will manufacture 1,000 units of whatever it is, butter, widgets, guns, whatever you want. The new plant can produce 1,000 units. Right, so price times volume again will give you the sales of those units. The variable costs are the same, is that right? Variable costs are the same, 50 cents per unit. And then we've got fixed costs, it's 200 instead of 800 because the new plant's more efficient for whatever reason. Better technology, lower energy consumption, doesn't matter. Depreciation is 100. Yeah. And same steps, same tax, same everything, same approach. You'll get a NOPLAT margin, looks quite healthy. ROIC, or it's RONIC technically because it's a new investment, so return on this new investment that I'm considering as a company, quite healthy, 22.5%. We need some kind of an investment of $1 billion in the beginning, so that's the CapEx at time 0. And we calculate this the usual way, so NOPLAT plus depreciation minus CapEx and change in working capital will give me this cash flow stream that at 8% I discount in the perpetuity, discount to times 0, and it's about 1.8 billion. So it looks positive. Looks like this is what we did in introductory finance, right? We have some kind of a project, we've got cost, revenue, working capital, discount everything at some discount rate, NPV positive, invest, right? So, first of all, before going to the next slide, can anybody spot any potential errors of logic in calculating RONIC? Well, the company created excess capacity in this industry, but assumed that they can easily sell the 1,000 units straight away. That's the first mistake. You can just flood the market with 1,000 new units of whatever it is you're producing and sell all of it immediately. That is unrealistic. You essentially said that your population increased by 50%, or your customer base increased by 50% overnight. Unrealistic. Unrealistic. I've never seen that before. I've never seen that happen. Okay, so that's the first sort of error in logic. But now, let's be more realistic and take this business, our existing business, combine it with this new MPV project to see what we get. Okay. So, we have, and the second error, sorry, I forgot the second error, was that the original project had $1.20 for each unit, and the new one $1.10. And this assumes, by just combining the businesses, it assumes that one plant, the old plant, can sell at $1.20 and the new one at $1.10. That's unrealistic again. Tier 2 price discrimination is illegal, and you have to set the same price. So the new price for all the units will be $1.10. Okay. So we combine the business using those two corrections. Only those two corrections. That's all we had to do. Just make it more realistic, and this is what we get. So all the units have to be sold at $1.10 instead of some $1.20, some $1.10. We have the 2,000 original units, and we have 1,000 of the new units, but now we have a sort of a delay, which is not that dramatic, not that drastic. You know, can only sell 600 instead of 1,000 in year one, only 700 instead of 1,000 in year two, only 800, and then you can sell everything. Okay? At $1.10. Everything else is the same. All we made, the only change is we changed the price a little bit because of higher capacity, which is realistic because of supply and demand, and we delayed how many units we can sell from the new factory. That's all we had to do. All the calculations are the same. There's no other changes here. WACC is still at 8%. The investment is still 1,000. I made no other changes here. So you go through the calculations, just like in the example in Waddle would be the combined, this tab in Excel. So plug and chug, variable costs, again 50 cents per unit, fixed cost just as sum of the two, depreciation sum of the two, tax is still at 25%, margin looks a lot lower, ROIC looks a lot lower. But now, even though ROIC is bigger than WACC, what happened here is I had to lower the price for all the units. So when I do my calculation for the combined business, same WACC, same tax, same everything, my NPV has gone down from the original number. The investment looked nice and juicy, 1.8 billion profit, I should invest. But once I combined the business and I made very realistic changes to the capacity considerations, and that's only this risk. I only did that. That's the only thing I did in terms of I didn't think about the interest rate going up, so WACC going up with the credit cycle ending. I didn't think about a competitor yet. I'll get to that in this example. I didn't think about anything other than the first one, other than the first risk with capacity. I only changed two numbers. That's all I did, here and here. Everything else is the same, voila. NPV overall goes down. What happens, and that's just considering me. If I have a competitor, which is quite standard, right, to have competitors in an industry, if the competitor was to expand, all right, analysis of existing operations if the competitor expands. So I expand, so I have my existing business. So in this tab here, we have my existing operations, but only the competitor has expanded. The only thing that changes is my price drops, and I can't sell all of my 2,000 original units, and not a big change. I think you would agree. It's only 200, 150, 100, not a small adjustments. And the prices drop. Everything else is the same. My NPV basically halves. And if we both expand, prices drop to something like 90 cents and then slowly recover as the market absorbs and hopefully finds the product good and useful. The adjustments are a little bit more aggressive on the negative side, but everything else is the same. Variable costs are the same. Fixed are just some of the new and the old. depreciation's the same, all the same, still at 8%, I didn't increase the WACC, I go bankrupt. Right. So what this is trying to tell you is that growth is not automatic. Right. Growth is dangerous potentially, and especially through acquisitions and expansions. And this is my point, that companies love talking about growth, investors love talking about growth, the market loves talking about growth, everybody focuses and loves growth. Growth is one way for you to go bankrupt. It is. And you have to be very careful when you do it as a company, you as an analyst. So when you're valuing a company, you cannot just assume that they can suddenly increase capacity and keep selling their product at $1.20. It's just supply and demand. That's all it is. Right? Have you noticed how Apple always says we have a shortage of iPhones? Brilliant. Brilliant. Let's be clear. There is no shortage of iPhones. Right? They limit the production to hike up the price. That's all they do. It's brilliant. But people think, oh my God, I have to buy now because I won't have one next week. It will be there. It will be there. The iPhone RX, the new one, the XR, whatever it is, XS, the XS Max, there will not be a shortage of iPhones. But the perception that there is allows Apple to charge $2,000. $2,000 for a phone. That's insane. It's amazing and insane, right? You can get a computer for $2,000, and they're charging that for a phone. That's brutal, man. And people buy it. I don't understand. I'm sitting here, and I don't know. And then they say, oh, there's a shortage of screens, shortage of chips, shortage of RAM, shortage of this, shortage of the black one, shortage of the coral one, shortage of the red one. There's no shortages. Nothing. It's artificial. It's brilliant. You have to say, Apple as a company, wow, like they know how to trick people. Right? They know it better than anybody else. I've never seen it. I've never seen anything like it. And people love it. People love paying $2,000 for a phone. I mean, taking people's money, anybody can do that, right? But taking people's money and making them like it, that's impressive. You have to say that is amazing. It is amazing. Yeah, it truly is amazing. I've never seen anything like it. And the brand name is just an Apple logo. That's all it is. And because of the logo, they can charge a premium of whatever, 40%. Right? Just because of a logo. Amazing. So be careful with the expansion. So what do you do as an analyst, right? As an analyst, now I've hopefully tried to convince you that growth can be dangerous, especially artificial growth, especially inorganic growth, the aggressive kind. What you should be looking for as an analyst when companies are considering a new investment or an acquisition. First of all, do not take the company's word for the investment. If they say it's NPV positive, great. Make your own valuation. Do not just say, oh, the company said it's NPV positive, it must be NPV positive. Don't do that. They always say that. It's NPV positive until it's not, right? So if it's NPV negative, by the way, there are situations, they don't happen anymore, but in the 90s and the 80s, great time, there were situations where companies engaged in negative NPV decision making. And they always said, it doesn't happen anymore, but in the 80s and 90s it did, they always said we made a strategic acquisition. Every time a company says we're making a strategic acquisition, sell the shares. It's not hard. Sell, short sell as much as you can. NPV decision, remember, it's a simple rule. With NPVs less than 0, you should walk away. It doesn't matter if it's strategic, non-strategic, if it's good or whoever's doing it, or this guy did an acquisition like this before. It doesn't matter. If it's NPV negative, a company should not be investing in it. It's destroying value. It doesn't matter that it's taking over a competitor. Right? So do your own sums, do your own valuation. Like this, like KGW, do bare bones, whatever it is, do a discounted cash flow valuation of the combined business. Yeah. So there's only 3 types of investments, by the way. So companies will say, oh, you know, this one's different. They always say that. This one's different. It's not different. There's 3 types of acquisitions. A capacity expansion, which is dangerous, very dangerous. Right? Capacity expansion, like I showed you in this example, you're just increasing your units of whatever it is you're supplying or servicing or producing as a company. View that with skepticism as an analyst, because no company in the world can escape from supply and demand. No company in the world. Next, type of investment is creation of a new product or a market. Yeah, so it is risky, more risky and uncertain, but if it pays off, it usually pays off big. Apple is the best example that I can think of a company that developed a new product or a new market that just worked, and they did very well. Apple is probably one of the, the most valuable company in the world, I think. Yeah, it's the most valuable company in the world. We can check that, which is crazy, because it's just a marketing company. I mean, let's be clear. Apple is a marketing company. They don't manufacture anything. All the manufacturing is outsourced to Foxconn, the Taiwanese company. Apple is not a manufacturing company. It's a design company. That's all it is, and a marketing company. And it's the largest, well, let's have a look if it is, Google Finance. So it's Apple. Where is it? So where's the market cap? Market cap. So it's a 1.05 trillion with a T, trillion-dollar company. The largest company before Apple came on was ExxonMobil. Doesn't say. No, that's not right. It's bigger than that. I can't think of. I thought that was huge. That's wrong. That must not consider the subsidiaries or something like that. It's a huge company, and this is an oil company. We have a world design on hydrocarbons, on oil. Apple, a marketing design company, is bigger than an oil company on which the world exists. That's insane, right? That's something you don't see. And the only reason why they are so large and so valuable as a company in terms of market value is because of number 2. They created a new product that became dominant, entered a new market in iPhone and tablets and smart devices. And they're able to, because of their brand name, because of their reputation and their skills, they're able to charge their customers ridiculous money for the products. And people buy it. It's amazing. So with that, it's risky, but if it works, wow. And second, the third one, which is the most safe, if you like, type of investment is efficiency enhancing. You make an investment to increase your overall efficiency of the company. So an example of Qantas is a very good example of that. An airline it's a tough business, but what Qantas did was they invested in a more efficient fleet. They invested in outsourcing of maintenance services. They're making investments overseas a lot of the time to reduce their costs as much as possible and make themselves more competitive. That is all the 3 types of acquisitions that exist. So when a company says this one's different, it's one of a kind, it's not. It's one of these 3. And when they start doing that, just growing, that's always be skeptical. It doesn't mean that they're going to lose money or go bankrupt. I'm not that pessimistic, but it just needs to be viewed from a realistic and a skeptical point of view. Number 2 and 3, if a company is doing that and your company, for example, is able to create a new product, so a good example is pharmaceutical companies. There's some horrible disease that's killing people. A pharmaceutical company comes along like Pfizer, like Merck, whatever, Bayer. They develop a new drug, a new medicine that they are able to get protection from competition on using a patent for 20, 25 years. So they are immune from competition. They can charge the price. They can set the price. They're price givers. They're price setters, not price takers. They're immune from competition for 25 years or 20 years. Yeah, that's usually a good sign for an investment that paid off and paid off big. Apple, for example, I mean that paid off big, right? Same with these efficiency enhancement investments. They tend to work as well. The one that you have to be very skeptical of is the capacity expansion one that gets completely misunderstood it's not misunderstood is the wrong word. Analysts just get complacent. They just think the good times are going to continue forever. Good times never continue forever. Right? At some point they will end. Okay. So, yep, go ahead. Can you say that again?
Like upward or buying suppliers.
Oh yeah, so yeah, products, yeah. So supply chain, so upward or downward stream acquisition. Yeah, it's for efficiency. Yes. So companies, it's a very good question. So companies, for those listening, companies expand. So there's a supply chain, obviously, and companies engage in upstream or downstream acquisition to get more of the services under their control to reduce cost, because every time you outsource, you have to pay the cost of somebody who manufactures the product or manufactures that part of the supply stream, plus their fee, plus their spread, because they are a company that also has to make money. So what the lady's asking is, when a company buys a competitor, Tesla does this a lot, they bought, so to build a car, it has a lot of moving parts, right? It has a lot of different units that are combined together. So Tesla this year, maybe in May or April, bought the company that created all the seats in the cars, right? If you're following the news. The reason why they did that is they were controlling more of the supply chain so that they don't have to pay somebody their costs and a spread and a profit margin to manufacture the seats that, of course, you cannot sell cars without seats, right? That would be funny. Interesting, right? But no, you can't really do that. So a lot of companies, like the lady asks, looks for upward or downward stream acquisition, and some companies want to control the whole supply chain, right? And this is my point about Apple. Apple doesn't manufacture anything. They outsourced all their supply. They're supplying zero. The only thing they supply is the design and the software. So design software company and marketing, that's all they do. They don't do anything in the supply chain space. Any other questions? Yep. So what can you look out for? What questions can you ask when a company is investing in doing this artificial growth? Where's the competitive advantage, right? So in management, strategic management, you talk a lot about competitive advantage. Competitive advantage is basically what advantage do you have over competitors that they cannot copy? And if there is one, could be a patent, like a pharmaceutical company that develops some drug for like cancer or whatever it is. If you are expanding your company to increase production of that drug, that no competitor can copy, that's a competitive advantage that you have for 20, 25 years. It increases the probability of success, right? So if you have that something that Apple, for example, the brand name that competitors cannot copy, Huawei and Samsung do not have the brand recognition of Apple. They don't. They're great companies. Huawei and Samsung are great companies. But they cannot charge $2,000 for their phone. They can't. Nobody will buy them. Nobody would buy a $2,000 Huawei phone. And they're great phones.
There's the 2004 Huawei phone.
Yeah.
So we cooperate with Posture.
Is that a luxury phone? Yeah. So if you put diamonds on a phone, yeah, it better be expensive. But a regular phone, you know what I mean? Because Apple, the XR Max, I think is going to be $2,000. That's a regular phone, right? That's insane. And if Huawei did without diamonds or some luxury good item, nobody would buy that, right? But something tells me that Apple's going to be able to sell even a $2,000 phone, which is insane. Next question, you should ask about, does the company have a competitive advantage that competitors cannot copy? Next, as a result of the acquisition, what is the impact of the industry structure? Will the structure change? Will it become more competitive? If the answer is yes, that's not good. Right? If the industry structure will change, if it changes for the positive, which rarely happens in an expansion, if it changes for the only thing I can think of for the company is you eliminate one competitor by buying it. But if you have a highly competitive industry with 20 players, it doesn't matter that you take one competitor out. If you have 3 competitors and you take over the other one, so it's just 2 of you, then yeah, the industry structure changes to your benefit. But in a competitive industry, acquisition is generally not to your benefit because you have to pay a lot and you can't really extract the benefits in a highly competitive industry. You can't just increase your prices. Right? If anything, you decrease your prices. How will other players react? It's a subjective question. If the answer to that question in your mind is they'll do nothing, that's naive. Usually they want to expand as well, or they'd have to react somehow. But it's hard to judge, I'll give you that. As an analyst, it's really hard to come up with an answer that depends on the industry, depends on the company. And the other one is, do I trust the management? Trust in management. Management, who runs your company, is more important than you think. There's plenty of managers who are crap. And I think, is it here or in a follow-up lecture, we'll talk about signs for good management. Let's have a look here. Is it here? Yes, it's here. So in a few slides, I'll get to that, what you should look out for management. First of all, always look at ROIC WACC. Always look at ROIC WACC and the relationship of ROIC, what's ROIC minus WACC. And if it's a large positive number, good. If it's a break even or a negative number, bad. But always, who's running your company? The questions you can ask is, have they done an acquisition before? How large was it? How much did they pay? Did it work? Right. Have they run the business? Have they created the business themselves? You know, Elon built Tesla from his garage. Jeff Bezos built Amazon from his garage. Steve Jobs built Apple from his garage. When you are building a business yourself, you understand it more, as opposed to some guy like John Scully, for example, coming into Apple and destroying the company, which is what he did. So if you read the Apple story, you have some professional manager who's been a manager for 20 years. Just because he or she has been a manager for 20 years doesn't guarantee success. Much better to invest in a company where the management actually created that original company because they are in the best position to understand it. So the example of John Scully, it's a fascinating story. So Apple needed a CEO. The board decided that Jobs was not going to be the CEO. He was inexperienced. And so Steve Jobs hired John Scully, who was the CEO of Pepsi, who was, had the best reputation on Wall Street, among the CEOs of corporate America. And he basically destroyed the company, right? So Steve wanted to grow the business, try to develop a new computer. He called it the Lisa, was the name of the computer. John Scully just looked at the margins. Too expensive. No one's going to buy it. No one's going to pay $2,000 for a computer. People are paying $2,000 for phones now. $2,000 for computers, I think, is fine. And he cut that investment. He cut that project. And then slowly, what John Scully did was he misunderstood where he was. He was in a research and development industry driven by innovation. He just looked at the costs and wanted to minimize the costs as much as possible because that's how Pepsi works. There's no innovation at Pepsi. The innovation of Pepsi is you have a new ad. That's the innovation at Pepsi. Right? The innovation of Pepsi is changing the font on the word Pepsi. That's innovation for that company. And that's John Scully's frame of mind, and he misunderstood that innovation in IT means coming up with a new product or a new service. And Steve Jobs had that mind frame because that mindset, because he created the business, and he was trying to he could develop the Apple I, which was a huge success. Apple II, not so much, didn't look at the costs. He just wanted to build a revolutionary product. And same with when he came back to Apple and saved the company. The iMac was a revolutionary product. The iPod that came after the iMac, revolutionary product. The iPhone transformed the whole company. And all those products were built on research and development, on coming up with a new product, not looking at costs. So having good managers behind the wheel of a company is critical. And always be generous to CEOs who created their own business. As an analyst, always, they have an advantage over outsiders who come. So McKinsey. So additional reading for the core for this lecture. It's not examinable, but McKinsey, the consulting company, identifies 5 ways that acquisitions can create value. Again, there's only so many acquisitions you can have. I think I had 3 different types of different acquisitions. McKinsey did it, not 3 types of acquisitions, but 5 ways that acquisitions can work. This is what you should look out for. Point number 1, improve the target's performance. So you're buying a company that is underperforming, which is what Wesfarmers did with Coles. And it worked and turned the business around. Next, consolidate to remove capacity. Essentially, you are buying a competitor in a low competitive industry. So there's 3 or 4 players and you're buying one. So then you're left with only 1 or 2 competitors. Generally, the regulator has a problem with that. Sometimes no, sometimes yes. In Australia, they do. We have a strong regulator, and the anti-competitive regulator. So if there's only 3 players in an industry, and one wants to, let's say number 1 wants to take over number 2 or number 3, generally the regulator steps in and blocks the transaction. They have the right to do that. But if the idea is to remove a competitor in a low competitive industry, that's a good acquisition. You're removing a competitor, and generally becomes a duopoly or some kind of you can control the price more as a company. These days, I don't know. I still see it from time to time. Number 3, accelerate market access to a new product. So very common, you have some kind of a new product or a new service. You're a young company, but you don't have any distribution. You have no way to getting your product or your service to your customers. So you partner with a distribution company that has, or established company in the industry that already has a distribution, and you use their infrastructure. Sometimes that's required by law. In China, that's required by law. If you're if you're a foreign company and you want to enter the Chinese market, you have to partner with a Chinese company to access the Chinese market. And a lot of this trade tension is because of that. That these tariffs that both countries are waging against each other is America complaining that when they go in business with a Chinese counterpart, they take the technology and just build it for less. And if that happens, I could see how they would have a problem with that. But sometimes, China is a unique example, but if it's not done by law and you're just doing it as a business decision to increase the distribution network of an existing company, that's also generally a quicker way for you to get your product or your service to your customers. Another sign of a value-creating acquisition is accessing to skills and technology. You see this a lot in IT, especially. A large company, Facebook or whoever, Facebook buying Instagram, right, or whatever it was. There's a small company that develops some kind of a new product. There's a large company that wants to grow and buys the small one, right, to access the technology or the skills of that smaller company. Happens quite often, especially these days. And the other one is pick winners and develop their business. You can already buy successful companies and hopefully make them more successful. The only problem with that is when you're buying a successful business, you have to pay more as opposed to buying an underperforming business. So the other ways to, you can, the reading that I have for you this week, this McKinsey article, it's about 30 pages from memory. The other ways you can, that the article talks about is making money from an acquisition is a roll-up strategy. The idea there is consolidating a big company, buying up small players. A big example of that in Australia is QBE, the insurance company. They bought a lot of small insurance companies, right? It's a good way to grow business. You make small targeted acquisitions. So you're a large company and you are always looking for that small business to buy, pay a small premium and incorporate that into your network. Yeah, QBE did very well with that. And a lot of companies do that as well. Facebook does that all the time as well. A transitional merger, you don't see that anymore. Transitional merger is very rare these days, but transitional merger is you buy a company to change your company. So you're a large company and you are in an unprofitable industry, whatever it is. You buy a small company and shift to that industry, start focusing on that industry only. Nokia is a big example of that. Nokia is on the verge of bankruptcy, but in the past, it wasn't a phone company. It was actually a paper company from Finland. Yeah, it was in the paper industry. It manufactured reams of paper. Right? It was originally a paper company. It wasn't a mobile company. But by going into IT and telecommunications, they saw huge margins and huge potential and profitability in phone manufacturing, so that's what they did. And always nice to buy cheap, always. That's a standard one for any successful acquisition. It's sort of related to number one. When you can buy something for less and for cheap, it's very nice. It's nice to get a discount, right? So it's always nice to get something for cheap as a company or an individual, even just like with anything. Like if you're buying a house is worth $800. You can get it for $750. That's a good deal. So same thing with corporate acquisitions. If you can buy some kind of a company for a good price, not a large premium, maybe even a zero premium. Or even a discount, like during the financial crisis. Bear Stearns, when JP Morgan bought Bear Stearns, they bought it at a very good price, $2 a share. So an example of that is Nathan Tinkler. I don't have time to go through it, but I Googled this name. It's a fascinating story, Nathan Tinkler. He's a mining magnate that is on the verge of bankruptcy or probably went bankrupt, but he made a lot of very smart acquisitions early on in his life and then made horrible acquisitions. So this is important. How do you judge? How do you judge? How do you value this thing? So ideally, you should do an NPV analysis of this transaction. Think of it as a new project, but remember the new project has to be incorporated in your existing business. With an acquisition, as with most things in finance, there is a difference between price and value. Please do not mix those terms. I think I said that 1,000 times in this class. Those two terms are different. The price for an acquisition, the price for a company you're buying, is its current market value plus a takeover premium. So if you're buying a listed company, this is its price per share multiplied by the number of shares plus a takeover premium, which historically is 30%. Between 20 and 30% historically. Also known as the premium for control. About 30%, let's say. That's how much the bidder has to pay the target shareholders to buy the company. The value of the business that you're buying is different from the price. The value of the business is its intrinsic or current value. How much are the assets actually worth? Plus any net present value of synergies of combining the two businesses. So if you like, value creation only occurs if value is how much you get, price is how much you pay. Value minus price is positive. That means intrinsic value plus NPV minus market value minus the takeover premium. If that's positive, your created value from the acquisition. Right? And the synergies can be revenue related, cost reductions. Usually it's those two. And the biggest one is by far, historically, cost reductions. You become more efficient. I think I have an example. Let's have a look at it. So I have a model for you, a DCF model. That's the wrong lecture. that I want to talk about before I let you go, week 8, and let's look at, that does not look right. Supplementary documents is the acquisition analysis. So the separate analysis tab gives you a discounted cash flow model, like KGW, just much simpler, right? Starts with sales, gives you sales times the margin, gives you the profit. Then you have other expenses. Then you have EBITDA. You can look at it in your own time. All the action, all the inputs are down here, as opposed to like KGW, which is after each line. Yeah. You have the WACC, you have discounting to time 0, you have the mid-year adjustment factor, the usual. Okay, so this is the difference. In this model, this is something that you won't find in KGW. Acquisition costs and benefits to the acquirer. So what we have here, we're valuing the target company, the company that the bidder is taking over, or the acquirer is taking over. And the acquirer, as a result of taking over this company, will have to pay some costs, additional costs, let's say 5. These are the fees to the lawyers and the accountants, 5 million, let's say. And also, the benefits to the acquirer are a reduction in costs of 1 million. The acquisition happens at the beginning of T+2. So at the end of during the T+2, there's a $1 million reduction by the end of the year. Then it's 2 million, 3 million, 5 million, 5 million in perpetuity for all the other years. Right? So that's how the target changes. This is not the combined company. This is just how the target changes. So if this was 0, this would just be, and we did the valuation, we would just get the intrinsic value. Now what we want to do, this accounts for the synergies. Right? So if you go back to my slide here, we're trying to come up with this. Yeah? The intrinsic value is if all the synergies are 0. It's just the valuation of the company if I had nothing going on here. So here I have an assumption of cost. This comes from down here. The costs are fees paid to your bankers and advisors and lawyers, generally 2% of the transaction, historically. We've got an additional synergies as a result of cost reduction in the target, as a result of 2 companies combining. So the target company becomes more efficient in terms of costs. These are going in here, reduction of the costs here. This is the addition. So this is the reduction of the cost, addition to the decrease. So reduction of the cost of the target after they combine. And then you've got some additional benefits. They could also be cost reductions. God knows, doesn't matter, whatever you have. This is a dummy example, company X, Y, and Z. Right? But you as an analyst, when you're considering an acquisition, you should have an NPV model like this with the synergies incorporated in the cost line. Then you have another line for just the cost of the acquisition, which is announced by the company acquiring the target. So you can just take that number. And then you have a forecast of some other synergies. And you can have, this doesn't have to be 2, it can be more. Depends on the transaction and the industry. But the point is, once you have those synergies estimated, everything else is the same. You've got EBITDA, you pay your depreciation, you get EBIT, you pay your interest, you get EBIT. Then you pay your tax, you get the net profit. You've got the standard dividends. Whatever isn't paid is retained. You've got a balance sheet. You've got a cash flow statement. It's here, cash flow statement. You've got asset section, and you've got the liability and equity section of a balance sheet. So this is the balance sheet here. Cash flow statement. Here's the NPV and the free cash flow calculation. So you've got EBIT after all the synergies. Pay your tax will get you NOPLAT plus depreciation minus capex minus change in working capital will give you the free cash flows. You've got some WACC estimation. Discount all these cash flows to 0. You've got a continuing value formula, some kind of perpetuity for all the cash flows after T+6. We'll give you a valuation of the value. And this is the value. This is this number here. This is this number. And then that gets compared to the actual price the company pays, which is this one in this example. And the difference is whether or not value is created or destroyed as a result of the acquisition. And that's what you as analysts have to do when there's an acquisition that gets announced by a company. You have to do a valuation, a DCF valuation, with synergies included in the valuation of the target. You don't value the combined company. You value the target after the synergies. You have to come up with this number, with that number. If you want to do as an analyst, you want to do a valuation of the combined business, no problem. Combine the business. Here's an example. I want to examine this, but there's nothing stopping you from combining the company and see how much it's worth together. You can do that. Here's a template that you can use and see how it's done. But generally, this is what you need to focus on as an analyst. What else do I have for you? I've got a few things before I let you go. This one slide is important. So investors love a growth story. I've talked about that. But the market is not good at distinguishing true growth stories from mere top-line growth. And top line means the top line of the income statement, so the revenue growth.